That is the reason why I think it's going to be harder to find financing in the future. Why is it going to be hard to get a loan next year? Thanks for helping us dive right into our topic. Topic today of why is it going to be harder to get funding next year? So many Americans currently have experienced that the credit bureaus have readjusted the way that they assess credit scores. So the average American has seen about a 20 to 25% drop on their credit score. In addition to that, with many Americans losing their job, going into a kind of cycle that it's harder for them to find a job, and their consistency of income is going to come into question. It is going to be more difficult for people to be able to qualify for loans. So the factors that the bank looks at is credit score, down payment, and income amount. All of this assesses ability to repay. And if you don't have a really good credit score and a really good down payment, it's really going to be leaning on how good is your income source and how much is your income. For example, a police officer could have really bad credit and really low down payment, but it's easy for them to get a home loan because their job is very secure. Same thing with a nurse. A nurse can have a very bad credit and very little down payment, and it's not that hard for them to get a loan because their income is very stable. So when you are in a career that doesn't have a stable income, it can come into question when you're getting funding. So between credit scores being compressed, people's savings being eaten up, and their employment is not stable, it's going to make more Americans. It's going to make it more difficult for Americans to get financing. And our system in America today is not a cash system. We are a debt-based system. Our economy runs off of debt, right? About 97% of what's in circulation right now is debt-based. It's not really cash-based. So when you reduce the amount of debt, that's going to have a significant decrease in the amount of property being purchased. So we're going to have some major losers and we're going to have some winners. So we're going to see major losers in New York, New Jersey, Chicago, California, Miami, like anywhere that's a very blue area and has a lot of international people coming, and a lot of international buyers. They're going to be hurt significantly because dollar is going to be strong compared to foreign currencies, and that's going to make it more expensive for foreigners to come and buy properties here. So it's going to cause a reduction in the amount of people buying. And remember, it's a simple supply demand thing. So if there's less demand and more supply, the pricing is going to be in effect, which is normally going to cause prices to go down. More supply, less demand, prices go down. Now, in addition to that, we're going to see, like again, I think earlier this week, I spoke to one of my clients, and they were buying a condo in New York. Saw prices for the condos they were looking to buy go down about 10% already in New York City, and they're holding off because they believe it's going to go down some more. And I told them, yes, it is going to go down at least another 10 to 20% more, the condo prices. Around the world, they're probably going to go down because condos get hurt the worst normally. But specifically in New York, LA, Chicago, they're going to go down a lot. Miami, condos are going to go down a lot. Now, in certain areas are going to benefit. Any areas that are going to be very good for taxes. So Florida in general, though, is going to do pretty good. I mean, it's still going to be affected and it's still going to be negative, but it's not going to be as negative as the rest of the world. A lot of people are going to retire. So 10,000 people a day turn 65 in America. So that's a lot of people going towards retirement, or coming close to retirement. And they're going to end up wanting to go to states that don't have an income tax. Florida, Texas, Arizona. In addition to that, they're going to be looking to retire. So most likely they're going to come to these states because it's warmer and have great medical facilities here. So we're still going to be affected. And it's still not going to be great in Florida either, but it's not going to be as bad as some other areas. So based off of all those negative factors, it's going to be harder to find qualified buyers. Lending is going to be harder, and the market the market to purchase these debt, because remember, whenever someone's getting a loan, they're reselling the loan to somebody else. That market to purchase debt isn't going to be really, that market isn't very large. Right now, the person purchasing all this debt is the government. But once post-election and they stop printing as much money as they're doing now, there's going to be less people available or less money available to purchase all of that debt. So I think that's going to make it harder to since there isn't going to be a market to purchase all of the loans available as well. So in the front end, there's going to be less people to qualify. In the back end, there's less people that want to buy this debt. And then after, right, interest rates are going to be held down to about the end of 2023. But after that, a lot of people are thinking interest rates are going to go up or start going, which that means any of the loans packaged in the past, those loans are less valuable because the note on them isn't going to be that great. So it's, any way you cut it, it's like it doesn't look good for bond purchasers. So it's very tough situation and to be in. So that is the reason why I think it's going to be harder to find financing in the future outside of the government-backed loans. It's going to be hard to find general, non-government-backed financing. So obviously that's going to play an effect into pricing. So what am I doing about it, right? Because everyone says their opinion. What are you doing about it? I'm doing all my refinances now. I'm trying to get all my refinances done on my multi-units, on my house, and I'm trying to just get that over with. Anything that I'm not planning to keep for over 5 years, I'm selling now. So I'm selling one of my duplexes, I'm selling one of my 5 units, and I'm basically closing that chapter of my life, keeping all my bigger properties, refinancing those properties, stabilizing my assets, holding on to my cash, and waiting for the great opportunities to come. So in the amazing areas, there's certain markets, there's certain cities I want to be in, and certain parts of that city are very, very hard to get into. So I'm not looking to have 80% price drops on these properties. If I get a 30% price drop on a property that I really want, I'm going to buy it. So normally when people are asking me, Pascal, I want to buy something now, should I do it? I never tell anyone don't buy it right now. I normally tell them, are you getting it for 30% off of retail? And if the answer is no, then it might not be a good idea. I do believe in the retail, in the sense, when I say retail real estate, I'm not talking about commercial. I'm talking about like a single family home selling at retail. So if you're buying a single family home and in that area it normally sells for $500,000, I wouldn't buy it. Now, if I find one that's selling for like $350 and it could use maybe $30,000, $40,000 in repairs, that is something I would buy, but not something that's retail $500,000. I'm just buying it for $500,000. I don't think that's a good use of your money. I think there's going to be a better use for your money. So sometimes people will be like, oh, I've done this and that and the other, and I've done well financially. There's not a question of are you doing well. The way I look at things is investing in an optimal pattern, setting up your finances so you can make the most of your money. And that is really the suggestions I'm bringing. This is how to get the increase your probability of getting the best return for your money.